Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. I'm Christian Allen, here with my co-host, Rodney the Pod Zabriskie. Rod, I feel like the pod should be just like, it kind of feels mysterious. So it reminds me of like a name of a serial killer. What do you think? If you just said, oh yeah, that was the pod.
Yeah,
Maybe not.
Every once in a while I do get people calling me the pod. And even for me, even though I hear it every week,
It's
sometimes
still a little
multiple
weird.
times in a week, then I'm like, oh yeah.
Who's the pod? That sounds cool. I'm just kidding. Okay, Rod, how you doing, man? How are
Good.
things?
Yeah, hey. I'm great.
Hey, good. Sorry. Thank you for getting that in there.
Yeah.
Today we're going myth busting again.
Yep.
So we did the first part of our myth busting series last week, I don't actually know when it's gonna come out. It might come out probably won't come out in consecutive weeks, right? So we'll probably but maybe it will. We'll see. Anyway, long and short is this is the second part of our myth busting. Now, let me remind everybody how we came up with the myths. This was a combination of Christian's brain and ChatGPT.
Yep.
So I did challenge ChatGPT, and we've made some adjustments in some of the myths that were like, those just don't quite fit, right? Or maybe they're not enough of a myth. But that's what we're doing. We started with 21 myths. In part one, we debunked or myth busted 8 of them.
Yep.
And now we're going to myth bust a bunch more.
Yeah. And can I just point out, so you challenged me at the beginning of the last one to make sure that we don't cover any of them twice. And I think so far I'm doing my job. So hopefully we can
okay.
hold this out.
And there's a big yellow mark over it. So if I bring it up, it's kind of on me.
Okay.
So, okay.
All right,
okay.
We'll do that.
Let's roll with this, Rod, then. So let me do a quick review. Here are the myths that we busted in the first episode. The first one is that high risk equals high reward. Real estate always increases in value. Alternative investments are too risky. The stock market is the only way to grow wealth. Investing in alternative assets is the only way for the wealthy. And you can ignore traditional asset classes once you invest in alternatives. Rod, I think we were one more. And all debt is bad debt. So I think we did a pretty good job though of being at least somewhat balanced.
Yeah.
In other words, we didn't sit there and say, we hit this idea that you can't just eliminate traditional asset classes because you're an alternative, or at least you likely shouldn't. Now, I say can't is a strong word. Can and can't do whatever the heck we want. But most effectively, most optimally, most people aren't going to be that. Okay. So I thought we were balanced, Rod. I'm going to give you the opportunity to be the first pick.
Okay.
So, Rod, what do you want to start with today?
All right. Drum roll, please. I am going to go with myth number 4.
That was a terrible
diversification means owning lots of stocks.
It doesn't?
It does. I think the
myth. Oh, okay.
So that's our first thing, right? We're deciding is it a myth? Is this a myth?
Is it a myth?
And by definition, diversification means owning a variety of different assets, right?
I think it means
risk.
a variety of different anything.
Yeah. Yeah.
Now, there's different levels and all of those elements, but in terms of just what is diversification? Diversification technically is owning different stocks.
Yeah.
That doesn't mean it's good diversification necessarily, but it is at least diversification in some way, shape, or form.
Yep. Agreed. Okay. Yeah. So we would say the myth part of that is that's just the way that almost everybody thinks of diversification. When you mention that word, again, like last time when we talked about when you mention the word investing, most people just think of the stock market. They're not even thinking of anything else. Therefore, in this case, they're only thinking about, oh, I own a variety of different stocks in different categories, different industries, whatever. Therefore, I'm diversified. And by
And
definition, you would say, okay, yeah, that's true, except
okay, so maybe the issue here, Rod, is that there's multiple ways to diversify, and that just represents a singular way to. Well, I shouldn't say a singular way, because you can be in different stocks. You can also be in different types of stocks, different
sure.
time horizons, different. So there is an element of real diversification. You can even go into like, REITs and things like that in mutual. Although maybe we should clarify this. When we say stocks, are we like literally saying stocks, like individual stocks, or are we saying like traditional investments, like including mutual funds, ETFs, all that kind of stuff?
Well, I think that goes to ETFs and mutual funds because that's why they exist. I shouldn't say that's the only reason, but that's one of the biggest reasons they exist, is to say, well, with a single purchase, you can be diversified across a variety of different stocks, right?
Yes. And
So,
potentially asset classes, right?
yeah. Yep.
Yeah.
Yep. Industries. Yep.
Industries, all that kind of stuff. Okay.
Yeah. So here's what I do. I don't reject the word diversification. I'll just add a word. I call it true diversification. True diversification is
true. We want truth,
going.
Rod. And Rod's going to lay down the truth. We have a truth teller.
Well, what I mean is not true in terms of truth, but true in terms of like straight, right? True north, right?
True
that kind
north.
of thing.
Okay.
Is more complete.
More complete. Okay. I like it.
So true diversification is not just the traditional market, right? So you're saying, well, if I only have traditional stocks, bonds, mutual funds, to me, I'm not truly diversified. But when I add, again, especially as a business owner, my own business, other people's businesses, real estate, commodities, funds, notes, all kinds of different alternative assets, then I become truly diversified. In other words, well, let me put it this way. A lot of times, people will tout, "Oh man, my investment advisor does amazing for me in the last whatever number of years. He or she has gotten me these kinds of returns." And then you look at the market overall, and you're like, "Okay, well, the market overall basically did the same thing, right?"
Right.
So
right.
if when the market was up, my investments were up, and when the market was down, my investments were down. So wouldn't it be nice if I had other places I could invest where if the market's up, I don't necessarily gain the same way. When the market's down, I'm not down. I could be the reverse, right? What I'm invested in could actually create higher returns when the market's down as opposed to the other way around. So that's kind of the point.
Okay. So I'm going to use I'm going to add a word with you, but I'm not going to use the same word.
Okay.
I'm just going to use the word well. Am I well diversified?
Okay.
And I would say that to the standard that I would like to be, I would say that does not in and of itself make me well diversified.
Yeah, I like it.
Okay, Rod, that was a good one. Okay, next one. I think this one builds right on what we're at. Okay, I'm going to go with myth number 14, which I think is actually a true myth, Rod. Alternative investments, I'm going to say are often too complicated for the average investor.
Okay.
Oh, sorry. I should take that back. I would say that the myth is that we think they are, right? But they actually aren't at all.
Yeah.
Because we talk about this all the time. Like, the reason that mutual funds and stocks become common and comfortable isn't really because we like understand them well, right? Mm-hmm. It's not that most of us like really know how to go pick, good companies that we're going to invest in or good mutual funds. Like, we just kind of, most people go in their 401k or their defined benefit plan even, and they decide, hey, what are the options? And I'll go with the one that is well diversified. I'll go with an age-based plan that puts me at an retire so that I'm mostly in stocks while I'm younger. And like, that's how we normally do it. But it's not because we like get it, right? So I would argue that putting in the same amount of time into the alternative space would create just as much, if not more, understanding about, one, how investments work in general, And I think the alternative space tends to do a better job of expressing and helping people understand that because of the fact that there's so much of a do-it-yourself element to it, right?
Yeah.
The other world is the commercialized, like, make it as easy as possible. And by the way, that is moving, like that's flowing into the alternative space too. There's more and more opportunities that are like, dollar cost averaging. So we're going to see more and more of that as time goes on. But there's a kind of a do-it-yourself mentality that exists around alternative assets. And so from that standpoint, I think that's really what the issue is. But I would say that for the average investor, if they're willing to spend even a small amount of time to do a little due diligence research and create some understanding, like, there's no way that this is the case. So my hard stance on this one is that it is not. So this is a myth.
Okay.
100% a myth.
One thought that came to mind is, I think about the evolution of the stock market to come to where it is now. And is it fair to say that when the 401k was introduced, in the 70s?
I don't even know.
The ease of investing in the stock market became just, so easy, right? So easy.
Yes.
Check the box on your, whatever, you're filling out your HR forms and you're in. And so, kudos to whoever decided to do that and just make it so easy for people to invest so that anything else just looks more complicated, is more complicated. So too complicated? No, it's not too complicated. If you care about the kind of returns that you're getting and the kind of wealth that you want to build, and like you said, you're willing to put in some time to get it, it's not too complicated. Right.
Agreed. Okay. Hard stance, Rod. Okay. That brings us to our third myth of the day. What's it going to be?
Okay. I am going to go with number 20, which is
20.
Alternative investments lack transparency.
Okay. Where do you want to start on this?
Well, Rod? Okay. So
I would say that that's initially my take is that in comparison to the traditional stuff that we see, like that have to have massive ADVs as an example.
Yeah.
Right. Like they're like 200-page ADVs. Like there is a difference in the level of transparency that exists, generally speaking. What's your take?
So I would agree with that. And therefore it goes back to, you get to decide who you're willing to invest with. And if you're working with a group and they put out a pro forma that you're happy with, and it's not very transparent, it's not 200 pages or even 50 pages, it's 10 pages or something, and gets the point across and makes you feel comfortable, you have to also be comfortable with the lack of transparency, right? Or you have to insist on only working with groups who create more transparency, because they're out there, right? There are those that do more on the pro forma, more midstream, giving you updates, sending information to create that transparency. So if it's a hard statement that all alternative investments lack transparency, then it's a myth, because there are a lot of options out there where you have the transparency, especially when you're talking about your own real estate that you own yourself, right? Or your own business or your own, whatever. Then you don't have to worry about what someone else is doing for you. In fact, I know a lot of people who won't invest in someone else's stuff, right? They're not willing to trust anybody, regardless of what level of transparency they're offering. They're like, hey, I can do my own. I know how to invest my own real estate. I know how to run my own business. I know how to whatever well enough that I don't want to go out and trust anyone else.
So this one is really up to you as the individual investor. Yep. You get to determine the transparency that you get with some of these. And to your point, but I will say this, the standard of transparency is higher in the traditional space because that's where that's where the volume is. That's
And is
where
regulated.
far and away the money is.
Yep.
And it's also the most heavily regulated, which comes with its pros and cons. So, all right, Rod, what do you think? Is this a myth? Is it not a myth?
Well, it's if stated such that all alternative assets lack transparency, then it's a myth, right?
Okay. If you stated it as alternative investments lack in comparison to traditional, then that would be absolutely true.
Yeah. As an accredited investor, you have the opportunity to invest in things that are less transparent or less regulated. Therefore, no one is telling them they have to put out the 200 pages. And so they don't.
Everyone gets the choice.
Yep.
Right. Okay. My turn, Rod.
Yep.
So I want to go clear up to the top, and I want to start with number 2.
Okay.
Rod, you need a lot of money in order to start investing. Now, this is obviously a very relative statement. And this is the challenge that we have with all of our myth busting is anytime you take, hard stances, like it's, that it gets a little bit tricky.
Yeah.
But here's what I'll say. Just the idea that it requires huge amounts of money to invest, I think that sometimes, this is the way I think of it. I don't think that that's a message that's out there in the first place, right? I think that that's a message that as individuals, we oftentimes tend to put on ourselves or think ourselves, or maybe we're like embarrassed that we don't have enough money, or maybe, we think when we get a little bit more money, we'll get more serious about it. Like all of those things come into play, but I don't think anyone is out there saying to people, you know what, you really shouldn't start investing if you only have $50 a month. Like, who's saying that, right? So that's just kind of ludicrous. Now, I will say this. Getting into the alternative space might take a higher level of just dollars, right? It might require some more money. At the very least, there are alternative investments that do require more. But to my point before, like you definitely don't need a lot of money to start investing. There are many, many places, and some even in the alternative space these days, where you can invest even with a relatively small amount of money. And I think anyone can agree that if you're talking about like $100 a month, $50 a month, that's like a relatively small amount of money.
Yeah.
Right?
Absolutely. Right. And again, especially if it's that broad term of just investing, then, you get a Robinhood account set up and it's really, really easy. Or again, we go back to the 401k, even though we were kind of somewhat bashing on the idea that it's just maybe a little too easy. Well, there you go.
It's still a form of investing
on a biweekly basis or whatever. You're doing it. So
okay. So first off, that is not a common myth that's out there. So ChatGPT, you blew it on this one. And number two, Rod, you absolutely do not need a lot of money. So our message to anybody that doesn't have a lot of money, but that's thinking about it, you just do it. The sooner you do it, the better off you'll be. And it just evolves. But if you don't start, you can't create that evolution anyway. So starting even with a little is absolutely the way to go.
And I agree with you that I think this one is more of that kind of self-limiting belief. And the challenge is it becomes a deterrent to doing any investing, which means if I feel like, oh man, I have to have just fill in the blank, whatever the number is, I have to have $10,000 saved up before I can start investing. Well, depending on who you are, $10,000 can feel like a lot of money. And
absolutely.
if I'm not motivated to start doing anything about it, then to your point, what you're just making now, that I'm losing time, the opportunity. Because if I say, well, only when I make whatever, 500 grand, that's when I feel like I can, get that 10 grand quickly. Therefore, that's when I'll start investing. Well, if I'm 40 by the time I get there,
wasted a lot of good time.
Yep.
Okay, Rod. So that brings us to our next myth to bust. And which one's it going to be?
I'm going to jump down to 17.
17. 13.
which says gold and silver are always a solid investment.
This is an interesting one. Because it probably depends on who you ask in this
That's
one, in this
exactly it.
case.
Yeah,
But I would say that my initial inclination is that anytime you say always, like that's but if you just said gold and silver are solid investments, like I would say that they probably are solid long-term investments, and solid is one of those words. It's a relative word. So if solid means a place where I can get a 5 to 10% type of long-term return, then gold and silver probably fits the bill on that.
Yeah.
Right.
Yeah. Hedging against inflation. Especially if I'm holding it, right, then it's a hard asset that I
asset. Yep. I've got my coins, Rod. Got them placed comfortably in their little safe that someone could just grab the entire safe and run off with that. But still,
they'd have to have
at least the gold coins are safe inside it.
Yeah. Yeah. So, and then the other thing that comes to mind too is, like you were saying, these are all like relative terms. How do you define a solid investment? Well, it depends on what you're trying to get out of the investment. Because if your criteria is, I only want to look at investments that create cash flow, well, gold and silver is not going to do that for you. Right.
Nope. Not doing that.
But if it is, I have to have, a certain amount of liquidity, I have to have, whatever. Well, okay, then it's going to provide certain things for you, but not necessarily everything that you may want out of an investment.
Okay, I can agree with that. So solid. Nothing's ever on always. So can I say that? That's too. I realize as I'm saying that, I'm like, maybe I shouldn't say nothing's ever and like maybe there are some times that there's an always.
There must be.
You get the point.
If it's never.
Yikes. Okay. The point here is that in general, gold and silver are solid investments, but we can't say that that is always the case. Can I just tell you, I'm a little disappointed with my own gold. It's been, I looked at the value. Now, I got to be honest, I don't know how sophisticated ITM trading is with their like online systems. So I don't know if it has a really good way of keeping the values on it. But I looked at my values and I'm like, it's like it was like very, very similar to what it was like a year and a half ago when I bought it. And I haven't kept up with gold because really for me, it wasn't about like buying that as like a big return producing investment. It was more like, okay, as an overall financial plan, I want to have good balance. And it just seemed like a good idea to have at least a chunk of money that was in gold coins in this case.
Yeah. And to
Silver
clarify,
could be that case too, but
to clarify for everyone, the philosophy that ITM, it doesn't use with everybody, but what they recommend is that you own not just any gold bullion or whatever, that you're actually getting what do they call it? Historical
coins. Yeah,
the actual coins.
I don't remember the technical name, but they're like they are there, and there is, and it's just not coming to me. But it is those actual coins that each
Minted
one
coins.
of them, like minted coins, carry different values. Anyway, they're really interesting and kind of fun. It has been, I guess, since it hasn't lost value, I guess it's solid. But from that standpoint, gold, it's just one of those things. It's usually an option. I'm not going to go and tell people like ITM is that you should be like heavy into gold and silver. I would say that it's probably a small portion of your overall investment strategy.
Yeah.
Okay, Rod, I'm going to take us all the way back up to did we do number 5?
I don't think so.
I hope not. Okay, number 5, Rod. Myth number 5. Timing the market is the key to success. It says is key to success, the key to success. Anyway, you get the point. Timing the market. So timing the market. This is an interesting one because I do believe that there seems to become more and more space, like day trader space, that believes like that is a timing the market game, right? By all accounts, that's what it is. So
Yeah.
it's not that there is no messaging out there that says like, hey, you can become wealthy by learning how to time the market. Now day trading is usually a little different than like trying to time the market in long-term trends. Like I think most people have decided that like it's nearly impossible in a long-term investment portfolio to be like, hey, I'm just going to get out before the market goes down and then jump back in with all my money. And again, because like there's just too much going on in a long period of time to understand that. If you boil it down into really short periods of time, you have a little bit more control over kind of what's happening. There's less variability.
Yeah.
So I think that there are people who have proven that you can be successful day trading and therefore timing the market. But I would say in general, this is an absolute myth. Anyone that believes this is like a general investment rule is likely going to be extremely disappointed. Rather, Rod, the focal point should be on things like the 6 core principles that we talk about and the 5 key benefits. If those are your focal points, you'll be much better off than you ever would be by trying to time the market. Now, I'll say this. I've literally never talked to, I shouldn't say that. We don't have a single client who tries to time the market. I have talked to people over the years many times who try to time the market. But as far as like the clients that we have, the people that we typically work with, that's not who they are, right? They're usually like fairly sophisticated in terms of utilizing things like tax benefits and things like that. It's less about, hey, how can I, figure out the exact timing? Now, I will say this though, Rod, before I turn it over to you on this. I have seen people make really smart moves ahead of the market, but I don't think that it would be like called time. I'll give you an example. Let's say that I believed that over the next couple of years, the real estate market was likely to so because of that, I want to carry some money in a different asset or maybe it's a cash type asset that I can easily turn in there. Like in a form that's quote unquote timing, but I don't think it's the kind of timing that we're talking about where we're literally trying to say, hey, the market's going up here. Like it's, you just know that at some point there are changes, and so you're basically hedging and taking advantage of it. It's a more holistic strategy, less of a timing methodology.
Yeah, but even in that case, it's still speculative, right? Because we don't know what the future holds.
Absolutely.
And I remember I had a conversation with a guy who lives in Florida, and in 2017, his strategy was to sell his home and rent for a couple of years because real estate values had gone up so much. He just felt like it has to drop, and so he was going to take advantage of that. And in principle, what he said was right, but timing was horrible because between 17 and 2021, values went crazy. So
we have another one of those, Rod. Remember, we didn't end up doing business with this group, but they had like $5-6 million just in an account, waiting to take advantage of when the market came back. Well, I don't know if they're still holding on and waiting, but if that's the case, they probably lost like, what would you say? They could have doubled, tripled their money during that time frame.
Yeah.
Like even if you did a poor job over that 5-6 year time frame, you like doubled your money. You know what I mean?
Yeah.
So
okay, so I'm
a little angsty.
I want to hit on this, and I'm gonna bring in one more myth before we close up.
Okay.
Because my thought on this one is that it's a philosophy. The philosophy is buy low, sell high. And
I agree.
In a sense, well, how can you actually do that if you're not timing it? Well, it actually just takes discipline more than anything, right? Because it's not necessarily timing. If I buy when I think it's going to go up, that's just a smart investment. But then when it goes up, I have to be ready to sell, not necessarily saying, well, I think I've hit the peak. Like if I'm waiting for the peak before I'm willing to sell, then
that's more of a timing.
That's more of timing. So the philosophy I think is sound. Obviously, that's how we want to grow our wealth. But But yeah, timing is kind of weird. Okay, but here's the next.
So that one is a myth.
I think so.
Okay.
The next one I wanted to bring in, though, because it fits right in with this, is number 8. Past performance predicts future results.
Well, since every disclaimer we've ever heard suggests the opposite of that, I'm going to say that's probably... Well, okay, predicts. Okay, so I say that I said that wrong, because really what the disclaimer says is it's not a guarantee of future result, but is it an indicator?
It's not even a predictor, right? So the disclaimer could say it's not a predictor, even though it doesn't, right?
It's interesting though, because at some level, like, it always has to be, because everything ties together in some way.
Yeah.
So like the idea that it's not there's no indicators within what's happening, like that's kind of silly. So it has to be an indicator, but it certainly is not guaranteeing us anything. And I think that's the differentiator.
And that's what I think is interesting about this one, is that because the disclaimer basically tells everybody past performance is not a guarantee of future results. And yet just human nature says, I want to invest in those things that have a proven track record. You know what I mean?
And we tell people that all the time.
Or let's look at the historical on it, and that's going to help me decide whether it's worth investing in.
Well, that's what we do. We look at our American funds. We go to our mutual funds and we say, okay, which American funds have performed the best? Yeah, I'll go with those ones.
Yeah.
Which again is ridiculous, because when you look at those in 5 years and someone does the exact same thing, there's almost no question that they're going to be picking different funds.
Yeah.
But then you just don't know that, right?
And when the rebalancing conversation comes up, that's really a hard one too, right? Because it says, look at the investments that have done really well and sell those and put the money into the ones that have not done. So there are principles out there that drive you away from that, but just human nature keeps pushing us toward this whole idea of past performance.
So, but the question is, Rod, is this fact or fiction? Is this a myth?
It's a myth if you say it definitively predicts. Okay. Right? Past performance predicts future results. There are indicators, there are things that you should look at and principles that you should understand. But if, Apple stock is at its all-time high, well, does that mean I should buy?
Maybe.
Right?
Okay, Rod, how many of our myths did we get through?
Okay, so out of 21.
Yep. We've knocked out 15?
15.
That's my guess. 15.
Yep, you nailed it.
6 more 15. Myths, and maybe I'll throw in another 1 or 2 for part 3. Hey, thanks everybody for hanging out with us. I hope you're enjoying it. If you are, please leave us a review. We need to boost our reviews. So if you're a regular listener, and we know there's a bunch of you that send us emails, if you're a regular listener, just take like 30 seconds, go on to Apple Podcasts, leave us a review. We would love it. Thank you, everybody. We'll talk to you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.